The broadcast is now starting. All attendees are in listen-only mode.
All right, good morning, everyone. How are we doing today? Can everyone hear me? Got green bars. All right, we're going to get going here. A little bit smaller group today, but still do our thing. I just got back into town yesterday. Went to a family reunion. I live in Costa Rica, went up to the U.S., to Minnesota for 5 days. So getting back in the swing of things, trying to get my routine back, which is very important. I went to bed about 8 o'clock last night. My wife's like, "You're going to bed already? You got to be in the routine." Subconscious works great, but you got to get it working for you, and routine's a big part of that. So let's get me warmed up by going through the disclaimer right away. All right, risk, warning, and trading disclaimer. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors or traders. There are no guarantees of profit, and most Forex traders lose money trading. Past performance is not indicative of future results. The high degree of leverage can work against you as well as for you. Before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should only invest money that you can afford to lose. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts or uncertainties. This presentation and all of its contents, including past trades and potential trade setups, is for educational and informational purposes only. Using any strategies, techniques, or software mentioned in this presentation is also risky. We make no guarantees of profit of any kind. The presenter is not a licensed financial professional and therefore will not give any financial advice or recommendations. All information in this presentation is our opinion and may not reflect the truth or reality in the world of trading. Please use your own good judgment and seek advice from a qualified consultant before believing, accepting, and acting upon any information in this presentation. This is not a solicitation to invest. Hypothetical performance results may have inherent limitations, some of which are described below. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. In fact, there are frequently sharp differences between hypothetical performance results and the actual results subsequently achieved by any particular trading program. One of the limitations of hypothetical performance results is that they are generally prepared with the benefit of hindsight. In addition, hypothetical trading does not involve financial risk, and no hypothetical trading record can completely account for the impact of financial risk in actual trading. For example, the ability to withstand losses or to adhere to a particular trading program in spite of trading losses are material points which can also adversely affect actual trading results. There are numerous other factors related to the markets in general or to the implementation of any specific trading program which cannot be fully accounted for in the preparation of hypothetical performance results, and all of which can adversely affect actual trading results. All right, we got that out of the way. Let's look at our schedule for the week. All right, couple notes for the week if you hadn't heard. Is that our beginners, I think it's Josh Casey. He's not going to teach this week. So this one's not there. And I believe it's Tony is not going to check the posts online. Make sure I'm not informing you there. But we still have the intermediate and advanced waveology this week. So be some good stuff on that. I know you guys were pretty excited about those coming up. So we had Clay's session last night. What are you guys finding? There's with as many sessions as there are you picking certain ones that relate to what you've been trading? Trying to catch them all, and some live, some in recording. How are you guys attacking the schedule? Try to stick to waveology in 62. That's good. Yeah, Sataj says there's so many. And it's the way this is set up is there's going to be some courses that day-long stuff that go with it. And so we kind of got the cart before the horse a little bit. We want to get it out and prove the value and the concept of it. But there'll be more and more question and answer / support sessions as the foundation of the session itself, supporting that course. So you want, it's a build concept. So if you've done, a certain amount of pitchforks already, you don't have to spend as much time with that. But if somebody's earlier in the process and they're using that to build some of their foundation, they may only be looking at the pitchfork and then working their way up until you get up to an advanced waveology, trade compass 62 type of thing. So, and some of them are good. We all try to put a certain amount of our spin on self-development and how it helps us. So playing them in the background even, and hearing the different ways that we've overcome and learned and adjusted our RAS. And it's important to hear that also, because at some point one of those presenters is going to click with your current situation, your current spot, and help you move. You have that quantum leap. So keep that in mind. It's a lot of times it's just that relatability. All right, so I took a little time last night after I got back, looked at my charts. I actually, first 2 days this week, I didn't really open my charts at all, and Friday last week. So I've been on a little bit of a break, which I don't normally do. Usually when I travel, I have my equipment with me and do a certain amount of charting, even if I'm not trading. So this is my presentation for the day. That is not a 7. What questions do you guys have? Questions regarding 62? If you want to talk wedges a little bit, we can. Or how we're seeing it with the 62, which we talked about a little bit in the last session. Just questions on different realities we see with the 62, whether it be on a 30-minute or different time frames. We've talked about the higher the time frame, the longer the wave, if you will, that you're going to enter on, but there's more slush in it. All right, we're getting a couple here. Let's see. When we're looking at trades, which EMA cross should we look at? Are they all equally important? So that's, should we focus on the cross at time frame? So that kind of goes back to the wave question, right? So you're going to get crosses, and if you look at when you get a decent sized move, you're going to get crosses on they'll kind of stack themselves. A lot of times you'll see like a 1 minute, then the 5 minute will cross. That trend is developing, and then the 15 minute, if that's the next time frame you're looking at, which then may drag the 30 across. And I spent some time at one point watching the 1 minute crosses, and the wave's just not long enough. When the 1 minute crosses, it may go 3 pips, it may go 15 pips. It kind of depends on where the higher time frames are going. This is one chart I looked at. There was a wedge called at the yellow line, so I drew a wedge there. And if we look here, let's put it at 3 up even. All right, so let's go back here. So if we look here, if we're at the 5 minute cross, 5 minute cross right here. That's not even on my chart yet over here. So 5 minute cross here, if we look, the 1 minute cross right before it. So I have it set, I went back to more of a traditional setup just to make it easy for you guys, where even on a 5 minute, my 13 EMA is in yellow and my 62 is in purple for 5 minute. And we see the 5 EMA in the green here. So it crosses the 13 and then we cross the 62 on the 5. And so if we look here, if I put my cursor here, we can see that the 1 minute had crossed about 10 minutes before that. So a lot of times you'll see a natural progression, not always, because the 1, as we see later here, the 1 crosses back over, but the 5 doesn't. The 5 actually is coming down and doing a pass and check. So it comes down, rechecks the 62 and the 5, comes down, rechecks it again outside, basically at the trend line, and then it takes off. This is a live chart, by the way. So the 1 minute, there's too much whipsaw on it. It's back and forth. You can see in here, it crosses. You're like, oh yeah, oh yeah, yeah, yeah. You get in, boom, comes back, goes up again, and then it takes off. The 5 minute is tradable from a length standpoint. The 15 minute gives a nice size wave. And that's part of the reason Steve advocates trading 15 minute on wedges, because when that wave goes, it's something that we can get into, make pips on more often than not, and move on to the next. So if we look here, the 15 doesn't cross until after, basically right at the wedge break. So a lot of times, if you watch the 5 cross, you're like, oh yeah, we're crossed. And we're starting to see a trend here. It's opening up a little bit after this pass and check. So we know that we're in a little bit of a trend potentially. Then we look to the next level. You could go 10 or 15 depending on which one you're watching. And we see, okay, now we're getting the cross there. So it's kind of like we're building a trend, if you will. And then it's just a matter of what methodology you're looking at to enter that trade. If we're looking at a wedge, a lot of times when it breaks and then it comes back and tests, this is one of the strongest. It takes patience to get it, because you're like, oh, we're broke, it's going to take off, it's going to take off. But if we look at this right here, which is essentially right here, 13 or the 15 minute just crossed, we come back and we know in real time with this wick that this 5-minute was that extreme. So you had a static extreme. Look here, crop this. It was probably real close. Now, it wasn't a 10-minute harmonic wave convergence with power 10 at that point, but definitely a qualified sell into the buy if you're a tab 29 trader. We would have been above 80 here in real time. But you want to watch that. And at the same time, a lot of times we'll see, if I had a handful of them on here, if I had the lower time frames with it, where it'll come, didn't do it here, but like price will come up, tag, let's say the 30-minute, pull down, come back, tag the 15-minute 62, pull down, tag the 5-minute 62, and then take off. So it's kind of a stacked progression, not so much tradable, but gives you that eye of what's happening. So, does that help answer your question, Todd? And more specifically, I watch the 5 and the 15, mainly because I'm trading mainly wedges, almost 100% now, just because they bring me to where it's almost like the D of a scan. A lot of times it is the D of a scan, but it brings me to the spot. And from there I'm looking for a 5-minute static, or even like a 10-minute static extreme on peak 10, retrace extremes. So. Would you say that 513 is significant in giving up? Hold on, before I answer that, Todd asked if I use Trade Compass for my wedges. I do, just for the ease of it. Again, I'm not a business builder there, but I like them. There's more than enough. The market is, after the big move yesterday, the market's kind of trying to figure out where it wants to go. I like the clean ones where it's a continuation. I don't so much like, I'm not a big fan of this one where the move's breaking out. I like it where I know, hey, we're in a strong trend, something like this here. Actually, we've already established we're on a second move on the 30-minute. I'm a big fan of when the 4 hours extreme and you're basically trading back into it. Basically you have a 30-minute retrace extreme. I'm trying to find one here. So there'll be one in this run generally. Let's say you had not a great example because it didn't break out real far. But when you have this type of setup, we've had a strong move, we're having a pullback, we know there's a good shot. We're looking down here, we're seeing, hey, on the 5-minute, we're looking at something like this. It's an easy move. It's telling you, hey, this thing's ready to roll. It's something that I was trading before wedges, so putting wedges on top of it, it's another additional confirmation. Brings you to the chart. You're not trade hunting. I'm actually working on getting it to where it's just, I come in, I identify the wedge, I set a lot of times if I have other things going on, I'll trade it on the break. I'll set an alert here. I'll wait for it to break. Is this a great trade right here? Yeah, absolutely. 5-minute extreme. But at the same time, if I set an alert on this line right here, I can wait for it to break 36. It's about a 5-6 pip break. That's about as big as I let them be. I can enter right here if I want. Do 10 pip take profit. If you're choosing the correct ones, the clean ones, if you will, getting volume of trades, you'll learn which ones to take and not take. It's a pretty high percentage. Pretty high percentage. If you're going to lose one now and then, yeah. But you should be north of 85, 90. And again, we talked about the other day how the EMAs are coming out of the top of this thing. The 5, the 13 on the 5, the 13 over here. So the other, just one other thing, Taj, also, and kind of plays into the questions I have here. Keep an eye on your your 5, 13, 62 cross on time period, but also keep an eye on like your 13, or sorry, like here we're seeing the 5-minute cross, the 30-minute, and now the 15-minute is setting up to cross the 30-minute. A lot of times when this 15 crosses it, you're going to have a strong move. Now, more than likely, you're going to have it's going to do a pass and check. Because if we look at our waves down here, we see that we're at 30-minute extreme, the 4 hours starting to pull up. We don't know, if this is a 30-minute retrace extreme. But if this comes back and checks this and takes off, and it drags that 15-minute 62 up, you're in for a good day there. So something to keep an eye on. And again, that 5-minute, not so important. You start getting the 10 and 15-minute cross in the 30. It's a 30-minute cross at that point, if you think about it. If you go to the 30-minute chart, you're going to be crossing on the 30. So something to keep an eye on. Would you say the 513 cross is significant in giving a heads up to reversal? Depends on time period. Maybe not so much reversal as in trend. So it doesn't mean, hey, we're going to reverse out and go higher than this point here. That this was the definite low. But it does signal that there's some type of trend setting up. Now, you are going to get times where it crosses and it comes right back over. But there is an indicator when we go in the progression where the 5 crosses the 13 and then the 13 crosses the 62. If we think in our mind, what does it take for that to happen? It takes a fairly strong move for it to happen. It's generally a one wave. If I'm not counting waves in my day, but it takes that pull to drag those EMAs across because it's an average of the candles. If you get any type of retracement in that movement, it's going to drag that 5 back across the 13 because the 5 changes that fast because it's only the last 5 candles. So does that answer your question, Janelle? Okay. Question here, is the 62 a confirmation of the 5 crossing 13, which in itself carries more weight to a possible reversal? I think that is almost the same question that I just answered. And again, it's the way I see it in them setting up is, it's showing what the trend is. And we're looking for a trend that's long enough that whether we're in at the beginning of the trend with harmonic wave convergence on a certain time level, or we're in at a retrace extreme, if we're watching a 15-minute cross and we're looking for a 5-minute pullback. Let's blow this up a little bit so we can see it better. So like on this chart here, the original 5-minute cross was right here. And then it kind of lollygagged around. And this is the UCAT at midnight. So midnight in the States, it generally doesn't move much in that time frame. So it's kind of lollygagging around, but at the same time, it's the 15-minute, because it moves slower, is pulling up. The 5 came over, it's kind of lollygagging also there, but then the 13 starts to move up a little bit. So it's because we're maintaining a price, the average of that price is coming from lower up to that maintained spot. Price is going up just a little bit here, and then all of a sudden we see, we're the 30 minutes cycling up, and then all of a sudden, in 3 candles, the 5-minute pulls all the way down. We look here, we got basically A, B, C, pulls down, real time we're static. That's what you're looking at when that 5's opposite the 30. And that becomes your entry right there, which the alert was right there. A lot of times the alert will put you right on the spot, essentially. Then it just becomes, how do you want to capture your pips? With a 5-minute harmonic wave convergence, or the clay wave at the very least, right? You can enter here. The nice thing about that is, from a money management standpoint, 5 pip stop loss out here is more than enough. You're covered at the bottom of that wedge. The downside of saying, hey, I'm going to trade the break right here is, if you want to cover, you have pretty much, technically should be covering this, plus a couple pips, because if it comes back and tests it and takes off, you want to be covered there. It'll do it on occasion. So then you can't, you're not, you might be 2% into 10 pips instead of 2% into 5. You just need to say, hey, is it going to be, what is your style of trading? And that goes back to defining that and then doing it over and over so you know what your numbers are. Build your spreadsheet. Okay, let's see here. That broke at 36, it's at 56. If you're just taking 10, 46 is right in here. It's choppy in here. The trade compass wedges they're pretty good. Again, I'm not a big fan of this, because we know we're pulling away from this 4-hour. Now it's really starting to step up the last handful of candles, but I'd rather that thing be, if you're looking at the 6, 7 pairs that are on Trade Compass, a couple of them are laying flat. This 4 hours just laying flat down here. You're like this instead. So then you're just waiting for this thing to start stepping down, and it's usually right in here that you're nailing it. So the intent is very, very clear of what's happening on the chart. Stacking probabilities. All right, any more questions? Whoa. This thing only does what I tell it. Might be a short one today. Do you guys find, are you starting to get used to the 62 on your chart and just kind of where it's helping you, where it's not, as a guide? when it's turning over, obviously sometimes in your head it creates a little bit of confusion. Ideally we're looking for those, those longer runs where it's, on time frame on a 15-minute or even a 5-minute time frame where it pulls down, pulls back a little bit, pulls down, pulls back. And that's the ideal, waiting for that. There's not much mystery in what's actually happening. So, all right. That's a really good question. All right, so Taj asks, when the EMAs are crossed and spreading, yeah, it indicates impulsivity. It definitely indicates a strong trend, right? Or that's our 15-minute 62. 13 comes in, crosses it, starts spreading down. So in this area, once we get the cross, right, as they start to spread out here, obviously at this point price is dropping down pretty strong. So we know, yeah, we know we've got a strong trend here. At some point, price is going to come back and it's going to check the 62 at some point. This depends on how strong that move is. If it's 30-minute wave above it, 4-hour wave, 8-hour wave, but we know it is going to check the 62 eventually. So the question Taj has is, when the EMAs start getting closer, can we make any assumptions? And let's say we have the 5 crossing in here also. So the 5 would have been something like this. If the 5 comes back and crosses the 13, you definitely want to be on alert. As far as trading assumptions, if I'm trading wedges / retrace extreme, when the 5 crosses the 13, I know there's a fairly strong stronger retrace on time period there. I like to see the 13 to stay outside of the 62. Ideally, the 5 to stay outside of the 13. It crossing to me isn't as big a deal, but when the 13 starts, hooking back or getting closer to the 62, then there's that potential for turnover, right? Especially if the 5 crossed it, and then the 13, which at that point it would have. So it goes back to selectivity. I know that, especially if it's been on a long run, and I don't want to say it's due because we don't want to be predictive or predict, but if it's due to go back to the 62, I just want to be conscious of that. So to me, it's giving me a picture of what's going on. The waves and/or harmonic wave convergence is telling me when it's okay or not okay to actually enter a trade. So because it can come to the 62 and it can blow through it and just keep going, but it can come to the 62 and check it and take off, and which is kind of what we're looking for. So, or when it happens, it's a good thing. So to do that, the 13 is going to flatten out. So it's not necessarily a bad thing, but it just kind of gives us an idea of where we're at in the game. If the 13, the cleanest, easiest is when you get this, way wide, right? And price pulls back, price is coming down here, pulls back a little bit like this, creates a, nice little wedge. And this doesn't even hardly flinch. 13 just keeps doing its thing because it moved down so quick, it's not caught up yet. You all of a sudden right here, you've got a 5-minute static extreme. I mean, your probability there of success is by reading the waves is much higher than if this 13, it has been coming way back in here. It's just a short little retrace and away you go. So hopefully that helps. So it's more, you're not really making assumptions as much as you're making observations of where you are in that move. Okay, good. Still trying to get my eyes attuned. It really helps when you said to avoid the jumbled mess. Yeah, absolutely. And it's funny because there's, especially if you're looking at a 15-minute chart, there's moves in there. There's moves that are, 7 pips, 10 pips, 15, where, you could get in and out of, even if you're pieces of 10 trading and make pips, trade, but it doesn't, it's too low probability. There's more higher probability trades other places in the market. So, why buck the trend? Or we don't even, it's not, when you've got that jumbled mess of, the 5's going one way, the 15's going another way. It just hasn't figured out where it's at yet, or it's what I call turning over, right? Where the trend is turning over. So let it establish. Different times, on a day where you have U.S. news in the morning at 6:30, and let's say it's, red folder news or a couple mediums, let that happen. Let the market set up and create a trend after that, and then capitalize on it. Clay is very good at that, from a patience and discipline standpoint. He wants to see the, strong trend / EMAs spreading out. Then he considers even looking for a trade. If that hasn't happened, next, he's just on to the next pair. So. All right, any last questions? I got one little self-development thing here today also. So, all right, I'd mentioned before that I like the multi-time frame 62s in order. Would the higher time frame EMA take precedent over the local EMA, say on a 15-minute chart? And would there be an order to the local and higher as well? So I run the 30 just to know where I'm at as far as things that are potential on a 30 reality. When I pulled the chart up, you notice I had shredder bands on it, shadow bands. So you can see what's happening on a 30-minute level. If I'm on a 15, I'm really looking at the 15. Again, I'd mentioned earlier, it might be crossing the 30-minute, which is, giving me some information that, there could be a strong trend setting up there. If you notice my chart, when I pulled it up, I didn't, on the 5-minute or 15-minute, I didn't have them all stacked there. At this present time, I like them to be in order because I like, When they're in order, you're in a trend. And when they're in order, and let me refine that statement, when they're in order and spreading out or spread out already, you know you're in a trend. And that's kind of the importance of it, right? From a visual standpoint, from a telling us where we're at standpoint. So that's the reason for doing it. Are there one more important than the other? Not so much. It's just, you know that when they are in order, that trend is established. You've had some type of move to get there generally. And in my world, I'm looking for a static extreme 5 or 10 minute harmonic wave convergence retrace, right? Pullback against that isn't screwing up the order so much. The 1 minute, I'm not as worried about. But a lot of times it's going to pull back to the 1 minute 62 and then take off. That's kind of the first line of defense, if you will. Then if it's a stronger one, it might pull back to the 5 minute 62. So I hope that helps. Janelle, are you in tab 29? If you're doing 10 minute, probably, right? Okay. So Janelle asked a question, not really a 62 question, which she said. Do you have any, but I will attempt to answer. Do you have any tips for how can I make it easier to catch the harmonic wave convergence 10-1 trades? I set static alerts on the power 10. Where do you set your static alerts? At like 87.13? $88.12, I'm guessing, not 78. Yeah, I mean, that's probably the most standard way to catch them, is to set a static alert on, the real close to extreme on the 10 minute, on the power 10. The other way to do it is set a static alert on peak 5 for like 88 and 12. Because if the peak 5 is at extreme, not the power 5, but the peak 5 on a 5 minute chart, that's going to bring you to the chart. You're having a retrace extreme in a lot of cases, but it's going to bring you to the chart to say, hey, where is my power 10? Because if you think of the power 10, it's the 10 minute, the 5 minute, and the 3 minute. So if the 5 minute is at extreme, the 3 minutes usually there or real close, and it's an average, right? So the 10 minute, even if it's up in that, the peak 10, if it's in that 70, 80 range, the average of those three is going to get you your power 10 to an extreme. So either way will work. More so, make sure you're watching the waveology classes, understanding which 10-1s you really, really want in the long term is the real goal. But if you're taking 10-1s with 30-minute not an influence, if you go back, if you push your charts back, you're going to see that properly executed, that you can get in, and even the ones that are against impulsivity, more often than not, you can get in and out of them, swinging the bat and not taking a strike. And then the ones that are retrace extremes are generally going to be a decent move. So hope that helps. All right, so as coaches, we're always sharing self-development stuff because we're usually, dig ditches. And today we're going to pay you, $100 to dig ditches. But tomorrow we're going to pay you $102 to dig ditches. And then the next day we're going to pay you $104.40 to dig ditches. And you keep getting this raise every day, only though you're doing the same exact thing. You're not putting out any more effort. Potentially, you just keep doing the same thing over and over, but you keep getting paid more and more for it. So that's the power, that compounding power of the Forex. So, any other questions before I wrap up here? All right. So thank you. You're welcome. What are pieces of 15? I'm not going to get into it. Taj, do you use tab 29, fast 33, or neither? I think you're a fast 33 trader, right? Fast 33. Okay. It's covered a little bit in the fast 33 training. It's mentioned in the fast 33 training, but I come next week and ask that question. Essentially, there's a 15-minute wave, and you're gonna, it goes up, it pulls back a little bit, it goes up, pulls back, goes up, pulls back, and it's taking just pieces of that wave. It's usually traded on, if we do pieces of 15 or pieces of 10, it's usually traded on a 1-minute chart, and it's taught extensively in tab 29, where you can potentially grab 3 to 7 or 8 pips in a fairly quick time frame, less than 10 minutes. But it is covered real heavily, and it's a style of trading in tab 29. So it mentioned occasionally in the waveology courses or waveology classes also. All right, so we're a little over an hour. Let's wrap it up. The disclaimer here, again, trade money that you can afford to lose, and make sure you do your demo trades and post them. That's how we learn. So thanks again. We'll see you next week. I'm back for my fall push. No more travel, so I'll have Charlie Delta on Tuesday, and on Wednesday we'll be doing Power 62 again. Awesome. Have a good day. Mac, have fun getting the kids off school. All right. Peace out.